At Insightful Value, we dig beneath the surface to uncover what the numbers might really be saying. And today's spotlight is on Insperity, a business services company with a surprisingly low stock price that's catching our attention. Is Wall Street overreacting, or is there something deeper going on? Let's break it all down. This video is for informational and educational purposes only. It is not financial advice. If you appreciate content that filters out the noise and zooms in on what actually matters, like this video and subscribe to the channel. So what is Insperity? This is a company that helps small and mid-sized businesses manage human resources, everything from payroll and benefits to compliance, training, and recruiting. Think of it as outsourced HR on autopilot. It's a leader in the professional employer organization space, and its business model is based on long-term client relationships and recurring revenue. Now, let's look at what's going on under the hood. Insperity's stock is down significantly over the past year. The drop has largely been driven by concerns around slowing client growth, higher healthcare costs, and a tighter small business environment. Revenue growth has moderated, and earnings guidance for the year was revised downward. Operating margins have come under pressure, currently hovering just below 5%, compared to historical highs closer to 6 or 7%. But here's where things get interesting. Despite near-term headwinds, the core business remains strong. Insperity still manages thousands of client workforces, and its client retention rates remain solid. The company is actively investing in technology and expanding its value-added services, which could drive better scalability over time. From a valuation perspective, Insperity now trades at a price that reflects a lot of pessimism, and that opens the door for potential upside if management can stabilize margins and reignite growth. Dividends have been a bright spot. The company has raised its dividend annually for over a decade, with the current yield sitting comfortably above 2%. Even with the recent stock drop, Insperity continues to generate positive cash flow and maintains a clean balance sheet with no long-term debt, which gives it flexibility. Of course, this is not a risk-free story. If the macro environment continues to weigh on small businesses, Insperity could face prolonged pressure on growth. Rising healthcare costs and wage inflation also pose structural risks to margins. Plus, competition in the HR tech and services space is intensifying, which could erode market share if the company doesn't stay ahead. Still, for investors looking for value in stable, cash-generative companies with a history of shareholder returns, Insperity could be one to watch. It's not flashy, but it's got fundamentals that could become more appreciated if the current storm clouds start to clear. At Insightful Value, we focus on companies just like this, misunderstood, overlooked, or unfairly punished by the market. We provide deep but clear analysis, cutting through jargon to highlight what really matters. Whether you're an investing veteran or still learning the ropes, we're here to help you make better, smarter decisions. Want more data, insights, and value breakdowns? Head over to insightfulvalue.com. And don't forget to subscribe, like this video, and stay tuned for the next analysis.